You're now listening to the Supply Chain Secrets Podcast, the ultimate insider's guide for all things ocean shipping. Presented by NYFI.
Hi, everyone. You're listening to the Supply Chain Secrets Podcast. I'm your co-host, Caroline Weaver, and with me is Lars Jensen. Lars, how you doing?
I'm doing great, thanks. Calling in from the lovely city of Bonn in Germany today.
Oh, amazing. All right, let's get started with rates. We've got a lot that we're going to go through today. Why don't you kick us off?
Sure thing. I mean, we've seen a lot of different developments. If we start off over on the Asia-Europe side, for example, Asia-Europe continues to decline. If we look at the SCFI quote, we're actually now below $1,000 per TE coming into North Europe. That is relatively weak, but mind you, it is not the same as the low points that we saw during Q4 2023. It was still substantially lower back then, but clearly not a strong perspective either. Then if we look at the Pacific, that one is most certainly weakening. We continue to see erosion in the quoted rates, but more importantly, if we contrast the SCFI developments here with what we see over on the paid spot rates on the NYFI market. Remember when we talked here a couple of weeks ago that the quoted rates suddenly increased on the Pacific? I mean, we went up something like $750 per FFE over just 3 weeks or so on the quoted rates. It looked like we actually had somewhat of a peak season, late peak season, building on the. Now we can see from the NYFI that that was actually not really the case. I ran the numbers again. I've done it before. So yes, you do have a 3-week lag time between the SCFI and the NYFI. Yes, you do a quote, but then somebody needs to book on the quote. You need to pick up the empty container, load it, gate it down to the terminal, eventually load onto the ship. So there's a lag time. But that means we can now see during those weeks when the quoted rates escalated sharply, sort of indicating a late peak season. When I now look at the NYFI rate, yes, there is an increase, but only a bit over $100, not 700 or so that we saw. So it's very clear there might have been a sentiment in the market late August, early September, that we might have a peak. But even if that sentiment was on both sides, both shippers and carriers, that sentiment would rapidly have evaporated because that's not what we see in the paid rates for cargo that was actually loaded. So I think we are at a point where we have to conclude, apart from the tariff-induced peak trough that we saw late May, early June, there hasn't really been much of a standard peak season on the Pacific. We are coming into what's now going to be the slack season on a weak note already. And this is only going to weaken now in the weeks and the month ahead as we go into Chinese Golden Week. And it's not the only market where we're beginning to see a weakening. Let's focus on a trade we rarely talk about, the Asia to South America trade. This is also where one of the indices, at least to look at out there, would be the STFI. So mind you, what we just talked about, the STFI measures the sentiment around the quote. But the sentiment is very, very clearly weak. If we start out looking at Asia to East Coast South America, so basically for the STFI, this is Shanghai down to Santos, we are at just over $2,000 per 40 foot. This is much lower than where we were over summer. This spiked at more than $6,000 per FFE. So we've gone down from more than 6 to now only 2 since early July. And in the last 2 weeks alone, we've seen a decline of more than $900 per FFE. So this is a trade where rates are now going rapidly downhill. If you look at the other coast over on the West Coast, it is actually equally bad. But that one is now at just shy of $1,300 per 40 foot compared to $4,600 in early June. This has been a little more erratic. We had a peak in from Asia to US West Coast early June. Then we had a trough coming into mid-July. Then we had another rally here at the end of August, not as large, and now down to a low point again. And it's lower than at any point here during the Red Sea crisis. So what I also want to sum all this up to is now we call it weakness. It's of course because we compare to a fairly strong, at least on most trades apart from the Pacific, fairly strong summer 2025. And we, of course, also compare to an exceptionally strong 2024. In that context, it looks very weak. In the context of where we were prior to the Red Sea crisis, it's not that weak, at least not yet. But what to me it does signal is that the continuing delivery of more and more vessel capacity during 2024, during 2025, that is what's really beginning to manifest itself now in the global supply and demand balance. It has not tipped in to global supply and demand overcapacity, not yet. Talking more about that later, I hope. That's not where we are, but we are approaching a market that's globally more balanced and not having a shortage of capacity. And let's again keep in mind the strong market last year was driven by capacity shortage owing to the Red Sea crisis. That's what's disappearing now and giving way to a more balanced market.
Okay, interesting stuff. Would you say that the Asia to South America market is maybe just more volatile? Like we're not necessarily seeing rates that are out of the ordinary, but it's the timing of how fast they're changing. Is that abnormal?
No, I would say we saw rates out of the ordinary over summer. We saw some very, very strong rates there for a while. And you can say that tallies with what we also spoke about, I think it was last week or the week before, that we have actually fairly strong demand development in most trades. You have seen substantial growth, also Asia to South America. I think some of this might have been a spillover effect of the US trade wars, so goods had to find other outlets. So you actually had a pretty strong period, but that seems to be coming to an end, at least from a supply demand perspective. And given we're talking Asia to South America, this is also in the throes of the Chinese Golden Week seasonality that we're coming up to now.
Yeah. So would we maybe expect it to decline? What are your expectations moving forward?
Barring anything else, yes, I would expect it to continue to weaken, as I would expect on Asia Europe to weaken, not sharply decline, but to weaken, simply because we are coming in to the normal slack season. How long does that usually last? Well, it usually lasts until we then begin to have a pickup towards Chinese New Year. And next year, Chinese New Year is late. Chinese New Year 26 is only on February 17th. So we could be in this slack season, at least if we follow normal seasonality, I would say, until sometime into November.
Okay. All right. Well, let's shift gears a little bit. You sort of touched on it a little bit while talking about rates, but let's talk about the tariff updates. What is the latest that's been talked about on social media? What's the latest that's been passed officially? What should we be focused on?
Yeah, I mean, if we start from your last part of the question first, what has been passed officially? Nothing. From a technical perspective, there are no changes. There are no new executive orders since we spoke a week ago. There's nothing new in the Federal Register. Everything is unchanged, also going forward. What has changed are basically several postings by President Trump on Truth Social. We had some last week that grabbed headlines. It's basically 100% tariff on pharma. 50% on kitchen cabinets and bathroom vanities, 30% on upholstered furniture, 25% on big trucks. Big is not defined. That in itself would likely have a significant impact on container volumes. There are some pharma volumes, but that's not really where the major kicker is. Furniture is a large part of volumes, especially on the Trans-Pacific. Now, mind you, in the postings from President Trump back last week, it was specific. It was kitchen cabinets and bathroom vanities. So a subset of furniture. So over the weekend, the thought process for many was basically, okay, fine, it's going to impact part of furniture. Technically speaking, he said in Truth Social, this would be from October 1st. So that's what, 36 hours from now? As of when we are talking here, there is no executive order, which means there is nothing on October 1st unless that comes an executive order. Could very well happen later today or tomorrow. But what I would then also point to is another posting from Donald Trump, basically an hour before we did this podcast now here on Monday. So that'll be Monday morning US East Coast time. In that posting, he says, and I quote verbatim here, I will be imposing substantial tariffs on any country that does not make its furniture in the US. So basically now we are going from 50% tariff on kitchen cabinets and bathroom vanities to a statement that there'll just be tariffs on all furniture from all countries that don't make furniture in the US. Make of that statement what you want. I mean, it's completely open for interpretation, but it seems, at least in the minds of the president, we are heading down a path where there should be tariffs on all types of furniture. And if that's the case, this is of major significance, especially to the Pacific, where roughly 10% of the volume moved are actually furniture.
Yeah. And I know the US used to be a pretty strong manufacturer of furniture, but over the years it's definitely dissipated. There's some that's still manufactured here, from my understanding, but most of it is offshore.
Exactly. Most of that has offshore. And I was about to say that ship, pardon the pun, but that ship left the port 20 odd years ago.
Yeah. All right. Well, we'll keep following that to see what actually materializes there. So we're also pretty quickly approaching the USTR fees. I think the implementation day is October 14th.
Yes.
What are we seeing in the news regarding that?
Yeah, I mean, what we're seeing is basically in line with what we expected, which means a number of different elements. First of all, we are seeing a sharp move by most of the carriers to simply swap vessels around in their networks. So if you have a Chinese built, or for that matter, Chinese owned vessel, you would have to pay the fee. So it's much easier to take your Chinese ship and put on, say, I don't know, Asia, Australia, and then take a Korean ship and put into the Trans-Pacific. You're basically all good. You don't have to pay. All the carriers are doing this, and they're doing it very effectively and to a very high degree. That also means that most of them have now also been out. I think the latest one I saw here on Monday morning was the HMM in Korea following suit with everybody else, saying there will not be a surcharge related to USTR, which makes sense because for most of the carriers, they're not really going to face much of a fee anyhow. Then we've seen another couple of other moves. We have seen a Seaspan. Now, Seaspan is not a container line. They are, to simplify it, they are just a company that owns container ships. Granted, yes, there's more to it, but for the purpose here, they just own container ships. They're headquartered in Hong Kong, which the problem here is if they own container ships there and they flag them in Hong Kong, these ships would be subject to USTR fees as well, which is of course not very nice for shipping lines that charter vessels from them. So they've just announced fine. They're just going to move headquarters to Singapore. They're going to reflag roughly about 100 of their vessels, which means that now these ships are no longer Chinese. Problem solved again. So very much as expected, the USTR fee simply needs to a reshuffling of the global fleet. Where it does have an impact is if you are a Chinese shipping line. Obviously, everybody tends to think of COSCO and OOCO, and for now, they have said they're going to continue to operate their services as per normal, but this is going to have a significant fee for them. They cannot avoid these fees, at least not the way the USTR is formulated now. There is a smaller niche carrier, Hede Shipping, HEDE, which is a Chinese carrier as well. They have just announced they're going to terminate one of their Pacific services. And frankly, I'm not surprised. I'm more surprised they haven't terminated both of the services that they operate. If the USTR fees stay intact the way they are, it provides a significant competitive disadvantage to that particular shipping line. The last thing maybe to mention is what was the purpose of the USTR? The purpose of the USTR, especially if you read the executive orders underlying some of this, is to strengthen and boost U.S. domestic shipbuilding. And none of the actions taken so far does anything to further that. It could just shuffle vessels around to other places. Has it led to less ordering of ships in China going forward? The answer to that, if you look in recent months of vessels that have been ordered, now mind you, it's not just container ships, it's all ships. No, it hasn't really led to any change in do people order ships in China or Korea or anywhere else. That's not really that much of a difference. And again, it depends on vessel types. Again, tankers, bulkers, container ships, whatever. Very round numbers. You have 80% of ships in the world will never in their lifetime call the US. So for the vast majority of the ships in the world, the USTR doesn't really matter. So when you're ordering a ship that's going to stick around in the world for the next 25 years, you have plenty of other more important considerations rather than will this ship necessarily be impacted by USTR if I build it in China. So in the order book pattern, there hasn't been any change either.
That's a good point. Some of our listeners might be wondering why some of these carriers are not actually trying to implement a fee, like using the opportunity to try to help boost up the rates. Why do you think that is?
No, it is a good question, and I would think under stronger market conditions, we might actually have seen them try to do so. The challenge here is, and that goes not just for USTR, but with any kind of new surcharge that the carriers implement. Over the years, we have seen that if the market is relatively strong and the carriers introduce a surcharge, there's a good chance that surcharge will come through, especially if you could justify it with a specific cost. ETS comes to mind when that came in Europe, for example, or low sulfur fuel fees, or there's been a variety of these fees where it's very evident there would be costs associated. You can then always have a discussion in terms of is it exactly the right cost, but the concept that there is a cost is true. And then if the market is relatively strong, that goes through. However, when the market is weak, what then tends to happen is if a carrier launches a new surcharge into a weak market, on paper, yes, they might get that surcharge. I mean, it's part of the invoice, it's part of what gets paid. But if you then introduce a new surcharge at, say, $100, in a weak market, you would likely see the base rate then at the same time be eroded by $100. It's not that these surcharges are completely isolated from your base rates. So I would also have a strong suspicion, especially when we look at the weakness of the Trans-Pacific market right now, if the carriers had gone down the path of launching a surcharge, it would likely have been completely ineffectual anyway, because it would have been eroded by a subsequent reduction in the base rates instead.
Okay. Yeah, that all makes sense. Thanks for walking us through that. One more item to talk about today. We sort of touched on it a little bit earlier, but what do you think is going to happen looking forward into 2026, 2027, when you're looking at all of the vessels that are on order, expected to become part of the fleet in the coming year or two? What are you expecting to see in terms of freight rates and the market in general?
This is where it becomes interesting. This is where we spend a lot of time the past many months looking at, I was about to say, the fire at our feet. What are the tactical issues? Sometimes it's good to look a bit further afield. We have an order book now of around 33%, which is quite large. Is it historically large? Not really in percentage terms. It was twice as large coming up to the financial crisis. However, and there's a major however, in the lead up to the financial crisis, we had a market where demand usually grew very rapidly. That's not been the case for many, many years. How much will demand grow from now until that order book is delivered? That, of course, is subject to quite some uncertainty, but around 15% is not a bad bet. That still leaves a major gap between capacity and demand growth, and then try to model out what does this actually look like. And it's not as easy as you might think. You might think, well, order book grows 33%, demand growth 15%, we have an 18% overcapacity. Not that easy, because there's a number of other factors we need to take into account. Factor number one, scrapping. About 13% of the world's fleet is older than 20 years, likely going to be scrapped at some point over the next 4 or 5 years. That needs to be taken into account. That reduces the overcapacity a bit. At some point in time, the Red Sea crisis is likely going to be resolved. That pours more capacity into the market. That will be taken into account as well. Over the last 15, 20 years, ships have gradually just been going slower, and slower. And with the likely implementation also of new carbon taxes from IMO, you have ETS, that slowdown of vessels is likely to also continue. Slower vessels takes capacity out of the market. That effect needs to also be taken into account. Then we have port congestion and vessel delays. If we have a lot of port congestion, that takes capacity out. Port congestion is resolved, that puts capacity in. So all of these effects needs to be taken into account. And I'm sure everybody is not going to stick around for the next 2 hours while I explain all the intricacies of all these different effects, putting them together. So let me jump straight to the conclusion instead. The conclusion basically being, yes, there will be overcapacity. Yes, there is too much capacity. Even when you take, for example, aggressive scrapping into account, it is not sufficient. And this is without taking into account, we are likely to see more vessels ordered. There's plenty of orders that are in the works with some of the shipyards out there. So there will be overcapacity. The major uncertainty then would be, when will the Red Sea reopen? We don't know. Simply. So at least in the modeling I tried to do, I assume that we revert back to normal sometime during second half 2026, which would likely mean an opening mid-2026, and then it's going to be the second half deal with all the chaos that's going to be in European ports. All of that means that 2027 is likely going to be the bottom of the market. This is where we would have had already a substantial amount of new vessels delivered. And at the same time, we would also have seen the delivery of all the capacity that usually goes around Africa, all going into the mix at the same time. After that, we will still have substantial order books being delivered, but then scrapping will also begin to ramp up effectively and take quite a bit out. So the outlook for now, if the Red Sea gets fixed mid-2026, is a cyclical bottom in 2027, and then a gradual improvement coming into 2028, which to some degree could be undermined if we have more vessels ordered. I deliberately use the words a cyclical downturn. Now, once this ball starts to roll, and at some point it will roll, I'm pretty sure you will see headlines with people calling it a market crash. Unless something really strange happened, I would shy away from using that word. In my book, that might just be me getting old. I still remember seeing the market crash of 2009 during the financial crisis. That was really, really bad. The depth of the cycle downturn we go into now is nowhere near what we saw back in 2009. For now, it seems more akin to what we went into 2015, 2016, which of course, if you are container line, is bad. Let's make no Just think about that. It is loss-making, bad, and it is basically awful. But this happens relatively frequently. Shipping is a cyclical industry, and that's basically what we're heading into. So from that part, it would be normal. The one thing I don't have a good answer to, and I don't think anybody has, it becomes pure speculation. When we have cyclical downturns, there's always some sort of price war every time. This time is different because in every other price war we had in the 80s, in the 90s, in the zeros, in the tens, the container lines basically all went into a price war from the perspective that there was a limit as to how long this could last or how it could go, because they would quite simply run out of money. Presently, a lot of the lines are financially vastly more financially solid than they've ever been in their entire history. So we would at that point go into a cyclical downturn, a potential price war with much more money in the pocket. What that would do to the play out, we can speculate, but honestly, I don't think anybody knows because we haven't had that situation before.
A lot going to be happening potentially. I mean, what you were saying
Yes.
is definitely dependent on some key factors, like the Red Sea opening up is kind of a crucial point in this prediction.
Yeah, I mean, it's a critical one because that's going to unleash a significant amount of capacity. Another wild card, which I deliberately haven't really built into the model because right now it's very, very hard to assess, is a U.S. recession. If we get a normal U.S. recession, you can say that's part and parcel. We get recessions regularly as well, and that tends to average out over time. The question is, if the current trade approach from the U.S. continues unabated for the next 3.5 years, what will that do to a potential U.S. recession? That remains to be seen.
Yeah. Yeah, hard to predict, the global dynamics of trade a few years out, but I think that's a pretty strong and well-supported hypothesis you've got. All right, anything else you want to add today?
No, I think we've been through most of it. I think I will circle all the way back to when we had the tariff talk, and we've had it a few times on the podcast as well. Let's be very clear in separating between what's being said on social media, even if it is by the U.S. president, and what is actually prevailing law. Because as long as the statements of new tariffs by Trump are solely existing on Truth Social, that means they're actually not in effect.
Yeah, that's definitely important to remember. Good call out. All right, everyone. Well, we will be back here next Monday. Until then, I hope you all have an awesome week. If you haven't already subscribed to the podcast, we're on Apple Music, Spotify, and on YouTube. So subscribe and make sure you're aware of all the new episodes. We'll talk to you next week. Bye.
Thanks for listening to Supply Chain Secrets Podcast, presented by Nice Shacks. Be sure to subscribe on your favorite podcast app. Want to be a part of the show? Register to attend a live recording at the link below.